Behold my 4 favorite ETFs, minus Qyld. I mean, I understand it. I've made a whole video on it, so check it out if you haven't seen it. But generally speaking, these 3 and kind of Qyld are really exceptional income producing assets, in my opinion. So in this video, I want to focus on Divo, because this ETF is very fascinating. I think it's very well managed. You can see here that it has a dividend yield of almost 5%, capital growth in the past year of 25%, and a total return of 34% over the past year. And that puts it somewhere between JEPI and SCHD when it comes to the general landscape of cash flow producing assets. Now, this ETF is what's known as a buy right ETF. So this is a list of a few buy right ETFs, and these are essentially, if I read the description, buy right ETFs invest by utilizing the covered call strategy. Okay, so pretty basic. These ETFs use covered calls usually to generate additional income. And we can see right up top here, we got the good old Qyld and then Divo. And then the rest of these ETFs, I don't really like at all. And if we come over to the 100 highest dividend yielding ETFs, of course, this is a very long list, but you're going to see that essentially all of these buy right ETFs are somewhere within the highest dividend paying ETFs. Okay, so aside from being a high yielding asset, what makes Divo better than all of these? Okay, so this is the official fact sheet for this ETF, and I just want to read a little bit, highlight some stuff, and understand this a little bit better, because this is an amazing fact sheet, and I think you guys are going to understand this investment a lot more in a sec. So Divo is an ETF of high quality, large cap companies with a history of dividend and earnings growth, along with a tactical covered call strategy on individual stocks. Divo is strategically designed to offer high levels of total return on a risk-adjusted basis. So much like SCHD, they hold lots of quality, large cap, dividend paying companies with not only a history of dividends, but a history of earnings growth. I think that's really awesome. And then on top of that, they opportunistically have covered calls that they do on individual stocks. So right there, that is just speaking my language. Now they have some bullet points over here. So these are 3 reasons to own, 3 reasons to own this ETF. So number 1, 2 potential income streams. Divo seeks income from dividend-paying stocks and by opportunistically writing covered calls on those stocks. So to keep it simple, writing covered calls on top of the stocks is the little bit extra that Divo has in comparison to SCHD. So that's why Divo has a almost 5% yield and SCHD has a 3% yield. And it does that without going to the extreme like Qyld, which focuses 100% on premiums from options. We can see that Divo did have capital growth of 25% last year. So it's a very well-rounded ETF in my opinion. And then number 2, it's professionally managed. Okay, whatever. Number 3, seeks to lower volatility. So dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So that's nice. It has a lower beta, but of course it's also on the flip side, when things go up, it might lag the market a little bit. Now this section right here is very well laid out, and the general simplicity of this ETF is one of the things I like most about it. So this is the selection methodology of this ETF. So we can see that the first thing they do is Divo is managed with a strong emphasis on owning high quality, large cap companies with historical dividend and earnings growth. In my portfolio, when I pick individual companies to own, this is essentially exactly the process that I do myself. So I like that right off the bat. The next one is sector allocation. Okay, so they try to be relatively balanced amongst all the different sectors. Okay, that's cool. I can respect that, yo. The next one is security selection. So Divo consists of only 20 to 25 stocks, which are screened and adjusted according to its attributes, including market cap, management track record, I like that one, earnings, cash flow, and return on equity. This is all great stuff in my opinion. And then the last thing they do is the tactical covered call writing. So covered call options are written on individual stocks on a tactical basis, and it doesn't follow any index. So it's just opportunistic. Whenever they see a good opportunity, they can write call options on their holdings. And lastly, coming over to the income potential, because that's kind of the whole point of all this. The strategy seeks to provide gross annual income of approximately 2 to 3% from dividend income. So right there, that's in line with SCHD, which is just pure dividend companies and has a yield of 3%. But then in addition, they want 2 to 4% from option premiums. So you can see nicely how the yield of right now it's 4.7% is split between the regular dividend companies and then opportunistic premiums on top of that. And if you do some basic math, you can see that they aim to have a dividend yield between 4 and 7%. Now, if we take a look at the holdings, because that always matters, they have 23 right now, and the weighting is over here at the right-hand side, and the names, of course, are over here. And I mean, generally speaking, these are great companies. Lockheed Martin, 3M. I mean, I can nitpick Chevron. Not super excited about that one. And it's kind of missing a few, maybe like T-Row. I like them a lot. But I mean, generally speaking, I mean, these are great companies. This is solid. So I hope I did a good job explaining why Divo kind of stands out to me and is more special than a lot of these other high-yielding ETFs. So there's a lot of similarities between Divo and SCHD, which is just the traditional dividend ETF. And they do try to increase their payout by 2 to 4% by opportunistically using option premiums, which I think is awesome. In my opinion, they have a very satisfactory dividend yield of almost 5% right now. They have great capital appreciation, and that culminates with a very nice total return. If you want to go one step further, you can go to JEPI, which has a dividend yield of 7%. They focus even more on options. I think it's like 15% of their portfolio, and it's more in line with the S&P 500 index versus Divo, which is more dividends and closer to SCHD. So you can see kind of how it fits in amongst the cash flow producing ETFs. And I think this is a great choice for a lot of people depending on your needs. If you guys enjoyed the video, leave a like before you go, subscribe to the channel, and I'll see you next time.